Inventory is soaring, prices are falling, and now many experts believe the frenzy is winding down for sure.
Home prices in our area are falling.
The U.S. housing market is standing on the same fault line that shattered America in 2008. Only this time, the tremor is bigger. Home values have skyrocketed 45% since the pandemic, while household debt has exploded past $18 trillion, the highest in history. Mortgage delinquencies are quietly climbing, and savings accounts are drying up. The cracks are already visible, listings piling up, prices stalling, panic brewing. This isn't a slowdown, it's the prelude to a collapse. In this video, we'll go state by state through the danger zones, places where overleveraged families, shrinking tax bases, and fragile economies are colliding. Stay to the end, because we're revealing the 10 states most likely to crumble first when the housing market finally breaks. Number 10. Maine. Home values here have climbed to over $400,000, while the median household pulls in just $74,000 annually. That's a price-to-income ratio that makes financial advisors wince. The state's emergency reserves cover barely 7% of annual spending, which means when tax revenues drop, services get cut immediately. No cushion, no backup plan, just consequences. Unemployment has already jumped from 3.6% to 5.4% in 12 months. Healthcare and tourism, the two pillars holding up the economy, are both shedding jobs. Consumer debt per capita sits at $41,700, and credit card delinquencies are climbing month after month. This tiny state attracted people with coastal charm and New England character, but the cost of living has outpaced reality. When the housing market corrects further, homeowners who bought at peak prices will find themselves trapped. They can't sell without losing money. They can't refinance at these rates, and they certainly can't afford to stay if they lose income. The economic engine has stalled, and there's no restart button in sight. From the chilly shores of New England, we travel to the blazing deserts out west, a place that promised endless sunshine and affordable living. But what once looked like paradise is now turning into a mirage. Number 9. Nevada. The desert seemed like paradise when remote workers flooded in during the pandemic. Median home prices rocketed from $250,000 to $483,000 in just 5 years. Population surged 18%. New subdivisions sprouted across sagebrush like mushrooms after rain. But that boom created a bubble that's now deflating in real time. Housing inventory is up 28% year over year. Prices are correcting. Buyers who stretched their budgets to move here are now sitting on homes worth less than they paid. The state's rainy day fund, 6.1% of spending, bottom 10 nationally. Unemployment has started climbing as tech layoffs and construction slowdowns ripple through. The economy. Over 22% of households spend more than 30% of income on housing, leaving zero room for error. Average household debt is $37,200. The state's GDP grew just 0.5% in the first quarter of 2025, signaling the growth engine has sputtered out. What was supposed to be an affordable alternative to California has become an overpriced trap. And when the national housing market crashes, this state's real estate-dependent economy will collapse like a house of cards. If the last state showed us the dangers of overbuilding, the next one reminds us what happens when the old engines of America start to rust. Because when the factory lights go out, entire towns fade with them. Number 8. Indiana. Manufacturing built this state. Steel, autos, factories that employ generations of families. But in 2025, those factories are going silent. GDP shrank 1.1% in the first quarter. Factory output is down nearly 7% year over year. Unemployment has jumped to 5.9%, with over 42,000 jobs vanishing in 6 months. The median home price is $246,000, seemingly affordable until you realize median income is only $63,000. Families have no financial cushion. Consumer debt has climbed to $41,000 per household, up 12% since 2022. The state's rainy day fund covers 6.4% of expenditures. That's barely enough for a short-term emergency, let alone a prolonged recession. Evictions are up 22% compared to last year. Renters, who make up a third of the population, are getting crushed as wages flatline and costs rise. Cities like Indianapolis and Gary are seeing housing vacancies increase and listing times stretch into months. The workforce participation rate has dropped to 60.8%, the lowest in a decade. This is Rust Belt vulnerability on full display. When manufacturing collapses and there's nothing to replace it, entire communities hollow out. And this state is already watching it happen in real time. And while the industrial heartland struggles, another part of America faces a slower, quieter collapse. Rolling hills, horse farms, and tradition, but beneath that postcard beauty, poverty and decline are creeping in. If you're watching this, you already know the cracks are spreading. Don't just scroll past. Subscribe now so you don't miss the full picture. We break down the hidden data the headlines won't show you. The signals that warn before the fall. Number 7, Kentucky. Bluegrass country might look charming with rolling hills and horse farms, but the economic reality is far less picturesque. The state's emergency fund covers 7.6% of annual expenditures, half what financial experts recommend. Coal tax revenue has collapsed 22% year-over-year as global demand evaporates. GDP contracted 0.7% in the first quarter, a clear sign the economy is shrinking. Unemployment sits at 5.6%, well above the national average. Nearly 18% of the population lives below the poverty line. That's 1 in 5 people struggling even before recession conditions worsen. The median home price is $213,000, but values are declining, especially in Louisville and eastern rural counties. When home equity disappears, families lose their financial safety net. The state's economy depends heavily on manufacturing, coal, and agriculture, all sectors that crater during economic downturns. There's no diversification, no tech sector, no financial services hub, just industries that are already dying. Average household debt isn't extreme compared to coastal states, but when you're already poor, any debt becomes crushing. If the housing market crashes nationally, this state won't just struggle. It will collapse into itself because there's nothing underneath to catch the fall. Some states fell because of what they lost. Others will fall because of what they gained too quickly. This next one sold the dream of coastal freedom, but every dream has a cost when reality catches up. Number 6, South Carolina. This state has been marketed as the new destination for growth. Retirees, remote workers, and families fleeing higher costs have poured in. The median home price has exploded to $388,000, up 52% since 2019. But median household income is only $63,900. That math doesn't work. Nearly 29% of homeowners and 42% of renters are cost-burdened, spending over 30% of income just to keep a roof overhead. Tourism and real estate development fueled the GDP gains, but both are collapsing in 2025. Economic growth stalled at just 0.2% in the first quarter. Tourism revenue in Charleston and Myrtle Beach is down 11%. Construction starts have dropped 18% as developers realize they overbuilt. The state's rainy day fund, 6% of expenses. Public services are already stretched paper thin. It ranks 44th in education spending and 47th in healthcare access. Unemployment has climbed to 5.7% with 38,000 jobs lost in 4 months. Household debt averages $43,800 with credit delinquencies rising fast. This state sold people a dream of affordable coastal living. But the dream is turning into a nightmare. And when the housing crash accelerates, all those newcomers are going to discover they bought into a market with no foundation. If you're seeing the signs too, drop a comment with your state below and hit like so more people wake up before the crash hits. Up in the mountains, the air's thinner and so is financial stability. Number 5, Colorado. Picture mountains, ski resorts, craft breweries, and a tech-friendly culture. That's the image this state projects. The reality? A massively overheated housing market sitting on weak fiscal foundations. The median home price in Denver has hit $631,000. Statewide, it's $570,000. Median household income is $84,000, which sounds solid until you realize 37% of homeowners are cost-burdened and rents have surged 28% in 2 years. The Rainy Day Fund covers 5.9% of the budget. That's below national averages and nowhere near enough to handle a serious downturn. Unemployment has risen to 5.4% with tech, construction, and tourism all cutting jobs. State GDP contracted 0.6% in the first quarter. The growth story is over. Consumer debt averages $48,900 per household, among the highest in America. Credit card delinquencies have jumped 3.1% since late 2024. Homelessness is up 21% statewide as people get priced out. Many millennials who moved here during the pandemic for mountain lifestyle are now trapped between high costs and job insecurity. The state ranks 42nd in per-student education funding despite having a high-income population. When the housing market crashes, this state's real estate-dependent economy will crash with it. The mountains won't save them. The desert boom is breaking. What happens when the Sun Belt loses its shine? Number 4, Arizona. Sun, sprawl, and speculation. That's been the formula for decades. But in 2025, the formula is failing catastrophically. The median home price statewide is $424,000. In Phoenix and Scottsdale, it exceeds $550,000. Median household income, $72,900. 31% of households are housing burdened, and many California transplants who moved here for affordability are now asking what they've gotten themselves into. The state's Rainy Day Fund covers 5.8% of the budget, far below safety thresholds. Unemployment has climbed to 5.8%. Phoenix alone lost 19,000 jobs between January and May. State GDP shrank 0.9% in the first quarter. The economy isn't slowing, it's contracting. Consumer debt per capita is $43,500 with rising delinquencies on credit cards and auto loans. Many residents are already living on borrowed time and borrowed money. The job market is softening in tourism, retail, and construction simultaneously. There's no sector picking up slack. Housing inventory has surged, but buyers aren't biting at these prices. Sellers are starting to panic. When the national crash comes, this desert real estate market will be ground zero. The heat isn't the only thing that's brutal here. The economic reality is scorching families alive. Next stop, the City of Lights, where fantasy meets financial freefall. Number 3, Nevada. What happens in Vegas doesn't stay in Vegas when the economy collapses. With 3.2 million people, this state has built everything on gaming, tourism, and hospitality. Those industries are consumer spending dependent. When recession hits, they crater first and hardest. Las Vegas has already seen a 13% drop in tourism revenue. Hotel bookings are down. Convention attendance is down. The Strip is still lit up, but the crowds are thinning. The median home price is $438,000, but Las Vegas prices have dropped 8.7% year over year. Investors who flooded the market during the pandemic are now exiting fast. Housing inventory is up 34% compared to 2023. Nearly 19% of homeowners in Vegas are underwater, owing more than their home is worth. That's a 2008 flashback that should terrify everyone. The state's Rainy Day Fund covers 5.1% of the budget, second lowest in the nation. Gaming and sales taxes make up over 60% of state revenue. So when tourists stop coming, the government goes broke. Unemployment has hit 6.3%. 22,000 jobs disappeared between January and April, mostly in hotels and casinos. Household debt averages $45,200. Delinquencies are spiking. This state learned nothing from the last crash, and it's about to get schooled again. This one shocks everyone. The so-called success story is cracking beneath the surface. Number 2, Utah. Nobody expects this one. It's been the pandemic-era success story. Population growth, tech sector expansion, Mountain West cool. But underneath the glossy surface, this state is a disaster waiting to happen. The median home price has rocketed from modest levels to over $400,000 in key metros. Growth came so fast that infrastructure, wages, and fiscal planning couldn't keep up. The rainy day fund, under 6% of spending. Unemployment is ticking up as tech companies implement layoffs and construction slows. The economy became dangerously dependent on real estate. When home prices were rising, everything looked great. Property taxes funded schools, construction employed thousands, consumer spending stayed strong. But now the cycle is reversing. Housing inventory is surging, days on market are stretching, prices are starting to correct. Buyers who purchased at peak are already sitting on losses. Over 22% of households are housing cost burdened, spending more than 30% of income on shelter. Average household debt is in the high 30s per capita. The state's GDP barely grew in the first quarter. Signaling momentum has died. Migration, once its greatest strength, is now a pressure point. Newcomers brought demand but not stability. Infrastructure is buckling, rental prices are spiking, and small businesses are choking under higher costs. The confidence that once fueled expansion has turned to quiet panic. What looked like sustainable growth was actually a real estate bubble inflating, and bubbles always pop. When the national housing crash accelerates, this state will be caught completely off guard because everyone thought they were immune. And finally, the state where every warning light is flashing red. Number 1, Louisiana. The Bayou State tops the list, and honestly, it's not even close. With 4.6 million people, this state faces every possible disaster simultaneously. The Rainy Day Fund covers 4.3% of annual spending, dead last in America. That's not a cushion, that's barely a tissue. State GDP shrank 1.4% in the first quarter, one of the worst contractions nationwide. Energy prices fell, offshore drilling slowed, tourism revenue dropped. Unemployment has jumped to 6.6% with 54,000 jobs lost since January. Oil and gas, tourism, shipping, all in free fall at once. New Orleans lost 15% of hospitality workers. Baton Rouge has seen construction halt on over 60 commercial projects. The median household income is $54,000. Median home prices are $225,000. In rural parishes, incomes dip below $40,000 while infrastructure crumbles. 23% of residents live in poverty. 40% of renters are severely cost-burdened. Average household debt is $42,000 with delinquencies rising fast. Flood insurance costs are surging. Utility bills are climbing. The state ranks 48th in healthcare, 46th in education. Over 1,000 bridges are structurally deficient. Water systems are failing. This isn't just economic vulnerability. This is system collapse waiting to happen. When the housing crash comes, this state won't bend. It will shatter. 10 states now stand on the edge of collapse if the U.S. housing market breaks. The warning signs are everywhere. Rising inventory, falling prices, disappearing buyers. The Federal Reserve can't keep rates this high without breaking something. Redfin and Zillow data confirm what homeowners already feel. The cracks are spreading. Between 2020 and 2023, millions thought they were real estate geniuses. They bought homes sight unseen, waived inspections, and paid tens of thousands over asking. Now, many are trapped, unable to sell, refinance, or even stay afloat. These vulnerable states share the same fatal flaws: weak fiscal reserves, economies tied to tourism and housing, and households buried in debt. When the market crashes, they won't have the funds to cushion the blow. Expect rising unemployment, foreclosures, and a wave of economic pain that spreads far beyond real estate. If you live in one of these states, act now. Build an emergency fund covering at least 6 months of expenses. Eliminate high-interest debt. Don't rush to buy. Prices still have room to fall. If you're already overextended, consider selling before values plunge. Renters should secure long-term leases before the eviction wave hits. Investors should stay far from overinflated housing markets. Focus instead on recession-resistant sectors: consumer staples, healthcare, and utilities, the essentials that endure through downturns. The message is simple: what goes up must come down, and the higher the rise, the harder the fall. Awareness is power, but time is running out. Stay informed, stay liquid, and protect yourself. The storm isn't coming, it's already here. The question now isn't if the crash hits, but whether you're prepared to weather it.